China's stock markets, new numbers on China's economy, and a major potential trade deal with implications for the world's two largest economies. Hello, I'm Nathan King, sitting in for Anna Naidu, and this is The Heat. When China's stock markets were recently hit with volatility, the story made headlines from Shanghai to Wall Street. Chinese investors suffered heavy losses as stock prices tumbled, but the markets have stabilized somewhat after regulators put controls in place. Meanwhile, there are new numbers out this week that give us an indication of the current strength of China's economy. Later, we'll also talk about efforts by the United States and 11 other countries to establish a massive trade deal called the Trans-Pacific Partnership. But we begin with China and its stock markets. Joining me now is Victor Gao, the director of the China National Association of International Studies. He's visiting Iceland and joins us very kindly from Reykjavik. And with me here in the studio is Yukon Huang. He is senior associate of the Carnegie Endowment and a former World Bank country director for China. Welcome to the show. First of all, I'd love to go to Victor in Reykjavik to get his take on the numbers that we've just seen coming out in the last hours or so from China. Latest GDP figures, current quarter, 7% growth. That's better than expected and also the same as the previous quarter. Your reaction?
Well, first of all, it's very obvious that there is a fundamental problem with the domestic stock market in Shanghai and in Shenzhen, especially in light of the recent very rapid increase in the stock market listed shares, as well as the more recent significant decline of the share prices. Now, there are different ways to look at the nature of the problem. Most of the attention right now by the government, by the investors, by the market regulators are very much centered around how this dramatic decline of the share prices happened. But I would say that the real focus should be why the share prices on the two stock markets in China increased very significantly until they finally crashed. Without looking at why they rose so quickly and so massively, it is very difficult to find the real reason why it declined so dramatically. So I would say when dust settles, we need to look at both sides of the equation very closely and come up with fundamental solutions to address fundamental problems which exist in the domestic Asia market. And I would say the massive amount of work which has been put into correcting the significant decline in the stock market by the government, by the major financial institutions, have at least achieved a temporary result of cutting down the significant decline and stabilizing the market. But what will be the eventual outcome of this whole significant melodrama on the stock market is yet to be seen.
Yukon Huang, do you think the government intervention, the regular interventions, sort of took the fear out of the market to try and stabilize it? And will that continue once these interventions are rolled back?
To the extent that government policies can restore a bit of confidence and put some calm into the system, then it's a good thing. But once you remove these things, whether the market will stay at that level or actually fall further remains to be seen. After all, some of these measures are pretty draconian. They basically said to the major shareholders in companies, you shouldn't sell. At the same time, they encourage a lot of buying. So you have actually very little pressures to sell, a significant amount of pressures to buy. No wonder, of course, that the prices have actually gone up. But once you actually allow people to sell and buy, once you let these delisted companies come back and trade, then it remains to be seen whether or not they can hold at the current level.
Do you see any comparisons with the US financial crisis when, you remember, there were dealings in financial shares was limited for a while, not being able to short, for example, in certain markets around the world?
Well, what this current stock market ascendancy and the decline has in common with the US is the introduction of leverage, margin trading.
Right.
Margin trading was introduced in China maybe 3 or 4 years ago. When the market actually started to accelerate, I think the government probably should have actually started curtailing or cutting back a margin, but didn't do so. And then basically expectations got out of hand. So market tends to go up too far when you have margin trading. When it declines, the tendency actually is to decline further than it should for the same reasons. People are forced to sell, and they're forced to sell beyond what they really want to sell.
And at a loss as well. Victor Gao, do you agree that margin selling, that is borrowing money, essentially, to buy into the stock market, and of course a lot of new people have come into the stock market, is going to be ultimately to blame here?
Well, I would say on the technical side, definitely the high rise in margin trading and the high ratio of margin trading is very much of a problem. Margin trading happened at the peak about 1 to 4. That means I just pay 20% of equity and I can borrow 80% of debt to buy listed shares. This is a very dangerous recipe, and the government regulators should never allow this to happen before or in the future. Now, I would say in addition to all the technical reasons which contributed to the significant decline of the share price, there were other major problems. That is, whether the regulatory focus was placed on the right issues that they need to care about, whether government intervention in the stock market should be viewed as an exception rather than the rule of the thumb going forward. So I think we need to address both the higher level of regulatory considerations as well as technical issues like the margin trade or short selling the stock market, especially in difficult market circumstances.
Victor Gao, as you know, the Chinese government have said that they want the markets to have more of an influence in terms of the economy. Do you think that the market somehow reflects the economy, or the two became disconnected? We just had GDP figures out, as we said, 7% growth for the previous quarter. Is there a disconnect between the markets and the real economy in China?
Well, first of all, I would say the government agencies which expressed eagerness to see that the domestic Asia market really pick up speed and become more reflective of the economic circumstances in China was a good intention. However, in implementing this desire by the government, whether there were too much of an implementation of this desire and whether, whatever efforts they tried to put into the market to boost the share price rise eventually backfired, that's another issue. On the other hand, I would say there are about 60 million to 70 million companies in China, whereas in the two stock markets in Shenzhen and Shanghai in combination, there are only about 3,000 listed shares. That means the shares to be listed on the two stock exchanges cannot be truly reflective of the totality of the Chinese economy. Many outstanding listed companies like China National Offshore Oil Company, China Mobile, etc., they are not listed in the domestic Asia's market. They are listed in Hong Kong Stock Exchange and New York Stock Exchange, for example.
Yep.
Companies like Alibaba are treated as foreign-listed companies. So I would say that the desire to make sure that the Chinese stock market reflects more and more the true circumstances of the Chinese economy is not to be achieved anytime soon. Therefore, we should not place too much of a false expectation on the domestic stock market so that eventually the over-eagerness to promote the stock market development, especially the steady rise of the listed shares, will eventually backfire on the economy itself.
Yukon Huang, several points there. What about this disconnect between the Chinese economy and the stock market on the one side, but also what Victor Gao was saying about how few of Chinese companies are actually listed? This makes it a very unique market in lots of ways.
Right. The connection between the real economy and the stock market is very tenuous in China. If you go back to 2006, 7, 8.
The first crash.
The first crash.
Yeah.
The Shanghai Composite Index went from 1,000 to 6,000, a six-fold increase, actually much larger than this increase. Then it crashed very quickly back down to 2,000.
Yes,
now, if you go back to those years, the economy was actually growing at 10% a year.
Right.
It had a tremendous trade boom. In some sense, the fundamentals said that the market should actually go up. But the reality of greed and what I would call excessive buying caused it to go up too much, and then it crashed. Now, here you have a situation where the economy is bumping along at 7%, possibly going lower, yet the market was booming. So you don't have what I call the rapid growth to drive the market.
Or the fundamentals.
Or the fundamentals. I think Victor is absolutely correct in mentioning that the government's intention to make the market play a greater role is a good one. The problem was implementation. I would also add another intention. The other intention was that China has a debt problem. Too many corporates have borrowed too much.
From banks. So
From
in
banks.
a way, they can borrow from retail investors. That makes it better, right?
Makes it better. So the government actually encouraged them to go on and list on the stock exchanges and use the proceeds of their listings to repay the bank loans. This is also what I would call a reasonable objective, to try to get the debt leverage down.
And diversify funding.
Absolutely. It's the implementation. And one of the problems here is there are many policymakers who are, of course, cheering on the market and want this process to continue. And the question is whether the China regulatory commissions should have also been doing that. In the United States, that would never happen. The SEC's role would not be to try to cheer on the market to go up higher. It would actually be out there primarily to look at risks and problems. And you don't have this kind of division between regulation and trying to promote the economy in China, as you probably should, as you have moved to a more market-oriented economy.
So given what you just said, do you think we're done? Because a lot of the investment banks looking at China disagree. Goldman Sachs said this week they think there's been a fast and furious correction and it's over. Others are saying we could see more. What's your outlook going forward?
If you look at it from a longer-term economic perspective, many analysts, including these investment banks, actually see the market being higher a couple years down the line, because China's equities are underrepresented in global indices. Up to June, China was trying to become part of the MSCI index, as the global index of emerging market economies.
The Morgan Stanley, yeah.
Right. And if it is, you would find that many investment companies, funds, would automatically need to buy more stock in China. That would automatically create demand, and some people were betting that that would actually cause the surge to increase. When that did not happen in early June, immediately the crash started to come, because people were actually betting on something to stimulate the market even more.
Victor Gao, just back to you in Reykjavik. What is China's average Chinese person's view on the stock market at the moment? Are people still eager to get in? Has it become an accepted thing now where people don't just put their money in bank accounts and get the poor interest rates, but do want to invest in China's economy, but also get a healthy return?
Well, first of all, I would say the total investors of the domestic Asia market as a whole is small relative to the total size of the population in China. The two stock exchanges come up regularly with stock accounts that have been opened with them, and these numbers add up to more than 100 million accounts. But there are many duplicate accounts. For example, I can open an account on Shenzhen as well as in Shanghai Stock Exchange.
Right.
Or I can use my brother's name, ID information to open another account. So I would say the actual number of real investors on the stock market in China are mostly representative of the middle class in the urban city centers. Very few farmers, for example, or migrant workers actually trade on the stock market. Therefore, I would say when we talk about the pain suffered by the public investors in China, it's mostly by the middle class and people in higher level of wealth, for example. So it does not represent the totality of the Chinese population, including roughly about half of them still living in rural areas. That's one way to look at it. Now, on the other hand, I think to really promote the development of the stock market in China, we need to take care of several major issues. One is this regular, very frequent, very unwarranted government intervention. Now, this time, people applauded the government in asserting itself into the stock market to try to stop the significant decline of share prices. But on the other hand, for example, the way you look at the draconian measures that the government regulators normally would take, for example, banning the new IPOs, or even forcing those companies which have achieved IPO on the stock market to surrender their IPO status, to return the proceeds raised in the IPO process back to the individual investors, etc. These things are unheard of globally and are very rare in China. But once you have such appearances, you really poison the overall environment atmosphere on the stock market, and also, very weirdly, you destroy the trust of the investors in the stock market. So how the government regulators will really take affirmative step forward in stopping their regular, frequent intervention in the stock market, this will be one of the most important measures they can take to make sure that the stock market will be very much market-oriented, market forces driven, rather than being intervened regularly once, twice, 3 times again by the government visible hand, which sometimes play itself very forcefully and very abrasively in the market.
Victor Gao in Reykjavik, thank you very much. Yukon Huang, thank you. We're going to take a short break. Fascinating look into the market. But next, a major potential trade deal with implications for China and the United States. Please stay with us on The Heat.